Welcome to Imperial Investment Insights Podcast. My name is Sanjay, Lodha.
And I'm Jamillah, Thabet. Today we are delighted to welcome Anthony, who is the Chief Content and Culture Officer at AmplifyME.
AmplifyME has been a frequent partner of Imperial and hosted many brilliant simulations for aspiring young professionals. Anthony has been with them for the past 10 years and has contributed towards its impressive growth.
We're very excited to have Anthony on the show and to dive into a conversation about markets and innovation. Anthony, welcome to the show.
Yeah, thank you. Thanks for inviting me.
To start off, could you please tell us more about your career journey and how you first got into finance and what your current role at AmplifyME involves day to day?
Yeah, so my career journey is probably a bit unconventional in a sense of I spent the last 20 years working in finance, but that was never the plan. When I was at university, I did a business management degree. It was a 4-year undergrad degree, so I did a year in industry.
Okay.
And in that year, I actually worked for an American marketing company. And so I had my eyes set on a career in creative advertising.
Mm-hmm.
And finance was not a thing that I was into. I wasn't like the students at Imperial, day one you turn up and you're kind of, right, I've got to be thinking about this and applying to that. I was very much more, I'm going to finish university and apply to some of these big ad creative agencies that were in London. It was only because of my older brother. He is an alumni of Imperial College, so he came here. He did his Masters in Finance here, but this is probably in the late 90s maybe, so a while ago. Yeah. He was the opposite of me. He actually wanted to work in finance from day one. I think he interned at a stockbroker at the age of 16, and he very early. So he actually, I was familiar with that kind of scene. Mm-hmm. So this was pre-financial crisis sort of era. I first went on a trading floor, I think I was about 16 years old, in the city in Bishopsgate, so right in the heart of the city.
Yeah.
And back then the trading floor was a very different place, and it was all kind of quite raucous, very busy, very intense. But all of the guys there, and it was mainly guys back then, they were all lovely people. Like they were kind of a different breed to a lot of the traders nowadays. So yeah, and then I finished uni. I was applying to these kind of agencies, if you like, in advertising. Whilst I was doing that, I got any job I could. So I got a job in sales, actually in recruitment, to just tide me over while I was earning an income and moved to London. I'm not from London originally. Okay. And then my brother, the company he worked for was a big US firm. They actually went bankrupt overnight. They were the largest listed American broker in the world in the late 90s, and their CEO had embezzled, I think it was $500 million out of the company.
Which company was this?
Refco, they were called. And my brother used to run the internal research desk for EMEA, essentially. And what happened was, because of that overnight, huge multi-billion-dollar organization going under, so he had a really good reputation for his research on his desk. He spun that out and started his own business with his business partner.
Amazing.
And at the time, I was working my job, doing these applications completely unrelated to finance, and then he had a startup business basically. So he found it really hard to hire people because he didn't have attractive salaries to give people. It was very long, very intense hours. The upside is later, not early. So then he eventually asked me to come and help him. And I actually took a holiday from my job to help him. And then after that 2-week holiday, I went back to work and handed in my resignation, and then went back to work for him on Monday. And that was the first 10 years of my career. So yeah, I had to learn on the desk. I didn't know a great deal, if anything, about economics really. When you do a business management degree, it's kind of, economics is one module that you do over 1 year. So I learned everything on the job. And then that job was basically market surveillance in intraday short-term markets. So my responsibility of me and my team was to literally wear a headset, and we were to watch and monitor every conceivable information feed for anything that could move any asset price in real time. So rather than like writing research about UK house prices or future interest rates, it was more like, this has just happened and we're commenting on it as it's happening, that sort of thing. So yeah, I did that for 10 years, ended up running that desk. We grew that business. It became, you know, global customers, hedge funds, banks, and you name it. And then we all disbanded, all three of us. And then we all went to do our own things. So my brother now works in fintech as a CEO. I joined Amplify. The founders of Amplify were former traders at a US hedge fund. They used to subscribe to my voice coming out over their trading floor. So I knew them for many, many years already before I started to work with them, which again is a lesson of networking and relationships, because I know when you're a student, it's really hard to get that first role. That job came from, we just had a beer and next week started working. Like, you know, it's very different later. It's not always quite so challenging. So yeah, and then I joined Amplify. Amplify at that time was a proprietary trading company. So we were trading our own capital in the futures market. But we've evolved like completely over the course of the last 10 years. We're now a fully fledged education technology company. We ceased trading several years ago now, because the business opportunity that we could disrupt what we were doing in our space and the adoption we could have on a scale platform level was far more than we could do as just a small group of people trading. And we all had kind of an entrepreneurial kind of itch as well that we needed to scratch. So yeah, and then my job today, so yeah, it's probably a bit of an abstract title. So Chief Content Culture Officer. There's kind of, I guess, the easiest way to think about it is the intersection between the students, universities, and then early career hiring teams at corporates. So on the, I guess, content side, my goal here is to have different forms of media. So we host a podcast that I run. There's a daily newsletter that I have. And so that's all about giving students access to information in a way that's easily digested at the stage that they're at. I used to hate reading the FT when I was young, because it's not really meant for me. It's meant for the now 42-year-old me, for example, an investment professional, for these sorts of things. Because there's a lot of it that's like unnecessarily complicated. There's a lot of language that's quite unusual. And so a lot of my mission with that is just demystify these sort of subjects. I honestly think that, I kind of put quantitative finance in its own niche, but outside of that, everything else is quite actually transferable and easy to understand for most people. It just seems complicated because of the access to the barrier to entry is quite high. And then also, of course, our main core product is our simulations, which is the same thing. Rather than students kind of go, I really want to be this or do that. And I know, for one, how hard it is to get an internship. It's near impossible because it's so competitive. So why not give people an ability to jump on a simulation, take the seat of what their future job that they're aspiring to do could be, and let them see what it's like so they can make better decisions for themselves.
I actually participated in that simulation.
Yeah, same.
And how did you get on?
They were good. Yeah, like you get an actual feel of what it is like to be in the role, as you said, pretty early on, which is quite good. Yeah. And you also get an idea if you want to do it or not by just like getting a flavor of it as well.
I absolutely encourage people, even if there's sort of two sets of people. There's people who have no clue what they want to do, or they don't really have great awareness of the different roles in finance, which is a big one, because people tend to be quite focused, concentrated on a very few jobs. Whereas actually the biggest area of employment is all the other jobs. It's because everyone goes after the most desirable jobs, and they're the hardest to acquire. So yeah, the other thing that I guess about my role is then the culture side, which to kind of break that down in something more meaningful, the culture side for the student is, as I've described, is making finance accessible for everyone. And then as a business, we've gone from a few people to now 50 people and more of a global company. It's kind of embedding an environment where we don't need to act like a big corporate, and neither would I really want to build that type of environment, in a sense of I want to give people the freedom, the flexibility to be able to experiment, to fail, to try things. We're still small and agile enough where we're a technology firm. We need to be pushing the boundaries all of the time to keep our competitive kind of edge in what we do. And so, encouraging people to feel safe that they can fail and these sorts of things, which is often a big thing I talk to students about, because they're very scared about these sorts of things when they go into a first job. They don't want to look bad and things like that. So a big part of my job is making sure that I've got like a pulse of what's going on kind of on the ground in our business and all the different teams to make sure that everything's working and that serving that mission.
I guess like these feelings, everyone can have them, especially if they're starting a new role. How do you ensure that like someone feels comfortable to fail in a new environment?
Yeah, it's something that I ask myself a lot, because it's one of the most common things I think that students feel. I think so one of the things I was writing about in a post that I did last week to our community was about having support, people around you that you can talk to, because I think what can often happen is you internalize a lot of this stuff, and therefore your mind starts to create then bigger situations than possibly are actually real. And so then it's about having a core group of, let's say, people that you can really be honest with, that you trust. And this goes, it's a funny parallel, because we do lots of work with lots of different types of people, and we actually do work with the Professional Footballers Association.
I don't know.
Oh.
Must have been something I said. No, so we do lots of work with different groups of people, and one of those is the Professional Footballers Association. And so I get to meet all these kind of unusual people, and one of them was talking about how football players deal with the pressure of, say, social media, because they're all young people and they're obviously quite active on social. But then if you're a public figure, like a sportsman like that, playing at Premiership level, you get a lot of negative kind of comments. And so one of the things there was like and the idea in finance is having this like board of directors, your own personal board of directors. Probably the most common ones would be your mum and your dad, or your siblings, your friends you went to school with, those who you have very strong bonds and connections with. And often they're the people who don't work in finance, because it's not about the technical stuff a lot of the time. It's much more innate, emotional, internal stuff, which is about your confidence, self-worth, self-motivation, and they're the people where you can really get into that. It's a weird thing, like the relationships you have, because when you talk about finance, particularly for a lot of Imperial students, you're going to work, if you go to work for a hedge fund, you're dealing with billions of dollars on a daily basis. It's actually quite hard to talk to people, like, I'm not going to say normal people, but people outside the industry, because then they look at you and go, what are you talking about? Like, because you're like, we did this, we lost like 100 million today, and you're like, what? And so it becomes almost uncomfortable, because you don't want to come across like, arrogant or anything like that. So you can have good conversations with different types of people as well. So mentors within the industry can give you that perspective, that work-life balance, but then those other core relationships can give you much more like support. And I often think the fear of failure is because you feel you're isolated, whereas if you feel you have a network of people who can pick you up, you feel more confident then that you're never alone is the main thing.
Yeah, I definitely agree with that.
So like I said before, AmplifyME, you spent several years working at News Corp. So what gave you the front row seat to live market events? What were some of the most interesting or intense periods you experienced there? And what was it like covering markets during the financial crisis of 2008?
When I saw you sent me that question, I was like, flashbacks to 2008. So I started on that desk in 2006.
Okay.
So I was still relatively junior at the time, probably like 2 years in when it was Bear Stearns I remember Bear Stearns got bought for like $1 or something like that. It was, and I remember coming into work going, okay, how does that work? Like they bought it for $1. And that was in March time, and then I think Lehman's was more like September, October time. So there was like, I think a lot of people who weren't part of that era think it all just exploded on one day.
Yeah.
Actually, it was ongoing for like 12, 18 months,
Mm-hmm.
and it was like a very slow, and then it kind of capitulated and compounded over time. So yeah, the early part of my career is really defined by that era, and I look back now and I think quite fondly of it. I don't think I did at the time, because at the time my job was to essentially aggregate information and present then our clients, traders, information before the market opened, so that they were fully informed to then speak to clients to make investment decisions for the start of the day. So they would normally get in at like 6:30, 7, because the market's generally open at 7 o'clock, depending on what you're trading. So I'd end up getting in at like 5:30 in the morning every day. So you get in and you'd spend an hour just trying to figure stuff out. You're like, what on earth has gone on here? And a lot of that would be, there's only so long I can stay awake before I need to go to sleep if I'm going to do it on a consistent basis. But at that period, you don't forget we're a relatively new business as well. So we're kind of lean on resources.
Yeah.
So you'd be in at 5:30, or I would be in to do all the grunt work because I'm the junior. And then we'd be there till like 9, 10 in the evening. Then you would kind of try and decompress, probably have a few drinks next door after work, and then go to bed, and then it all goes again. But it sounds quite intense, but when you're living it, it's pretty enthralling. It's quite exciting, and I think you either feel that or you feel like it's just too much.
Yeah.
My background was very much in sport, so I liked high pressure. I liked working in a team. I liked like the challenge of like uncertainty, all the skills that I actually have come to find in my career that a lot of talented academic students maybe don't possess so naturally. I actually had all of that. I didn't have the academic part, actually. I had all the other stuff. So I actually really enjoyed that, and I found it a combination of quite thrilling but also highly addictive.
Okay.
I wasn't trading, I was analysing the market. But you're analysing the market in perhaps one of the most sensitive, important periods of modern history. And I'm right there with access to all of the best tools. I'm seeing all the information flow. I've got access to all of the systems. I'm seeing it, and then I'm watching Sky News, and I'm going, Sky News, live news. It's like, that's not live news. That's like 5 minutes old, which in trading world is like dinosaur. So I really got off on that, and then you start to be like, well, I want to be the first person who knows everything. Like, that's my innate kind of sport competitive nature.
Yeah.
And that's what drives you then to get up, to do the hours, to do all these things. So yeah, and then during the financial crisis, I think quite different to say modern day crises that we've had, because of a lack of regulation, information, transparency. No one really knew a great deal of what was going on, and people would look to me and go, what's going on? And I'd be like, there was nothing, because there was such loose regulation back then.
Yeah.
There was no information about the depth of the issue, like subprime, that these banks had exposure to. And then you got to really see just how behavioural the market was. Like, the fear was tangible, and I'd cover rumours about, I distinctly remember a rumour about Barclays going bankrupt. And I banked at Barclays all my life. I've got all my life savings, my monthly paycheck goes to Barclays. I'm on a microphone saying, I'm hearing a high quality rumour that Barclays cash points are going to run dry at 4:30 this afternoon. And all I'm thinking is, I need to get down to the bank and withdraw as much of money as I possibly can. And what you would see was that you'd get these outflow numbers and huge like retail deposits, like people's life savings being pulled out of the bank. But at the time, and what kind of exacerbated the issue, was that Barclays, like all the other banks, there was no like ring fencing of the investment activities, the speculative side of the bank and the retail side.
Yeah.
So all of the speculation they were doing in the market was built on my mortgage and my money, as well as every other Joe on the street. That's why it was such a Wall Street impacting Main Street kind of scenario. So yeah, it was very interesting times. I think the amount of information, the stress and the length of the work, just meant that you learned a great deal very quickly.
Definitely,
I think it was tough, but you came out the other side and you were like, wow, I've probably learned more in 18 months than I would have learned in 5 years.
Yeah.
Were you actually able to find like an opportunity during that time?
An opportunity, what, in the market?
Investment related, yeah, in the markets.
Yeah, I mean, one of the biggest things was the kind of decisions you make in the face of the greatest level of fear, which is kind of this investing analogy, because, and I know we'll go on to talk about it a little bit, but when you talk about kind of retail traders, they tend to sort of come in at the end of a theme, and that's when you know it's kind of the end of the theme often. And that's not their fault, it's because of their connectedness or the disconnect between them and what's happening. So yeah, I mean, often when things are going really bad, I mean, a current day example might be, say, Microsoft. And Microsoft fell 10% on its earnings. They got hit yesterday. There's a lot of questions about the SaaS model with AI changing, displacing some of the revenue streams. And then Microsoft drops 20% in a few weeks, and people are like, "Oh, write off Microsoft." And it's like, whoa. It's like, actually, you have to ask yourself. I mean, Microsoft is one thing; it's a corporation. But back in the subprime, you were talking about sovereignties. So, like the UK, is the UK too big to fail? You know, because that was the terminology of the day, too big to fail. And there's financial institutions that were too big to fail, and RBS was the one at the time. So RBS now and NatWest. A lot of young people won't acknowledge that RBS back then was the biggest bank like in the world. They basically had acquired lots of different banks, and they were sat, and from an asset kind of value, they were the biggest. The idea being that if you think of like a graphic in your head of RBS in the center, and a financial institution's job generally is to lend money to different participants in the economy, lots of companies, other banks. They were so systemically important to the system, it can't afford to fail. So at that point then, I mean, a lot of the, if I think back to some of the guys who really did well out of that era, they were the ones who were buying when you would have thought your natural emotion would have gone, that is the most stupid thing you should be doing right now. And just, they actually, took the bet that they were too big to fail, and we're going to pick up at this lowest point on the premise that the government in the end will step in and we'll be able to like ride it back up.
So actually the government bailed them out?
Yeah.
They actually failed, but government bailed them out.
So I remember at the time it was, so you have these overnight lending facilities that banks will tap if they need it in an emergency. So someone like RBS, I think there was one evening when they were short to open the next day of $200 billion. They required a short-term, one-day loan from the Bank of England for $200 billion. So at the time, you're like, this is not a small amount of money. There's only one place this money could come from, which is the government. Because at the end of the day, the government can just create money, so to speak. And don't forget, things like QE and stuff was created on the back of all this, but a lot of that didn't exist at the time. It was like those government interventions were quite meaningful. And I think having lived through those scenarios now, when I see things like the sovereign debt crisis in 2011, the COVID crisis of 2020, the AI potential bubble, or whatever it might occur in the future, I think you do have a little bit more of a reality of, at the time you read financial media and it's the world's going to end, we're all going to be displaced from our jobs. But in reality, it's quite different. And actually, it's almost like that point of greatest fear often allows the greatest opportunities, which is actually pushing against your human instinct. But when you live through enough cycles, it gives you confidence that actually, rather than a theory, it actually has proved true, and I've seen it in that way.
Yeah, that's very interesting. So let's move on to understanding today's markets. So when you wake up each morning and look at the markets, what are the first 3 things you check to gauge the mood of the day?
So yeah, my life now is a lot different than it used to be. Like my life now would be make my daughter a bowl of cereal, probably wipe my other daughter, to get her ready for school, put her nappy on, But yeah, in my markets job that I did for 10 years, yeah, I mean, like I said, you're an addict. So the first thing you do is turn on your phone, and the first thing I'm looking at is, what have I missed? And what have I missed is identified. When you're used to looking at market prices on a daily basis, you can just look at a screen of numbers and you know what's out of place. Now, there's obviously visual cues that help with this process, because if you have access to like a Bloomberg terminal and stuff like that, you know, there's visualizations from a color perspective, heat maps and things like that, which give you a lot of immediate feedback as to probably what's happened. So that's the first thing. You look at market prices because you know where things closed. And then, so we used to run a 24/6 operation. So we'd close Sunday, but there's a global market open pretty much from Sunday night till Friday night. So the overnight team we had, and this would be the same in a large financial institution, because you have a team in London, New York and Singapore, for example. They would have watched the markets overnight, and then they'll give you a handover. So it's normally a very short, literal, like bullet points. This is what happened with the Chinese data. The Japanese election just happened. This was the outcome. The yen did this. The rates curve's doing that. And so between looking at the numbers and looking at that kind of quick fire, concise summary, you're pretty much there. And then when you get into the office, which in my former role would have been like 6 o'clock in the morning, there's no actual point looking at Bloomberg or news services at 5 a.m. in the morning, because none of the London bureaus are open yet. All of the European corporate earnings, for example, don't really happen till 6:30, 7. So you're almost too early at that point. There's no point going, I'm going to get in early to get an edge. It's like, well, that's not always appropriate. And then you get in, and then there's a little bit of information flow between 6 and 7. And then the cash markets for stocks and so on open at 8. So really the busiest part of your day, undoubtedly, or the role that I did, was 6 to 8. So, you know, you would forego breakfast because you're up so early and the adrenaline is running, and you literally have to do lots of tasks to make sure that every stone has been uncovered. I mean, I can imagine now there's lots of efficiency tools through AI I'd probably use to help speed that up, but back then it was much more manual. And then after 8, you're like, market's opened, I've done what I can do. And then you just see the markets play out. There's some economic data happens, you have a bit of a lull late morning, and then you do the whole thing again because the Americans come in. And the beauty of sitting in London is you get to see the end of the Asia session. So you get to see the end of Japan, Asia, China, India, all of those markets. Then you get the full Central European, UK, and then you also get the main bulk of the US. So being in London's quite useful from that perspective. It's actually quite hard to then span across all the different geographies when you're in one or the other, west and east. But being central is quite useful. So yeah, that would be the process.
Amazing.
And if you had to summarize the current state of global markets in 3 big themes, what would they be?
Yeah, there's so much going on. I actually wrote some notes of like 3 probably main things to distill it down to. Because I think there was another question that you had about how to kind of pick out the signal from the noise. But sticking with the themes, the main one always is to think about, with all the information that's happening in the world, ultimately, what does it mean for interest rates? Because whether you're trading bonds directly, but whether you're trading FX, equities, commodities, everything then is a derivative of what is the interest rate at that moment in time. Now that can be localized to the product that you're looking at, but generally speaking, the US is the dominant one. So if we think about simply global trade, is denominated largely in US dollar. And what is the value of the US dollar? It's largely based on our future expectation as to where interest rates are. So all of the inputs feed into that narrative. So as a theme then, the most consistent one is always what's happening to interest rates. And therefore, what are the influential factors that could shift people's expectations? So looking right now, it would be inflation. It would be the labour market. It would be US growth, for example. So right now, it's US growth is surprisingly resilient. I mean, it tends to be that way in recent times. But if inflation starts picking up and the labour market, let's say, is not as soft as people might have first envisaged, well, then that's not good for inflation in the sense of inflation moving up. Well, then we are currently pricing in rate cuts. Maybe the amount of rate cuts that we're pricing in is not realistic, and we should be thinking there'll be fewer rate cuts. So what does that mean for big tech valuations and the AI bubble? I mean, that brings that into more question again. You know, what does it mean for, and you kind of filter it out like that and feed through. The other layer that's the second theme that's connected to that is, well, if interest rates and monetary policy are so critical, the problem you have now is that the chairman, Jerome Powell, is about to leave, right? So we've had in the last week of us talking, like Kevin Walsh is coming in. And so this was a really big topic for markets. And it's not that one man can decide the policy. There's obviously a committee there, but he is the most influential as the chairman. And so that as well is another unknown. Like, as a market participant, what we can do is look at Kevin Walsh. He used to be a Fed member, so we can look at his previous behavior. We can look at what he says at the moment about the economy, because he sits on lots of companies' boards and things like that in recent years. You can get a sense of what his view, his perception of the world is, but you don't know until he's got the role. Think about anyone. Say if you're running to be the president of the Imperial Podcast Club, and you're saying, I'm going to do this, I'm going to do that, and then you get there and you go, I've got no financial means in order to make these things happen. So then what actually gets executed is different to what we thought your pattern of behavior might have been. So that's the other thing. And then the third theme is probably the importance of politics. And that's not a new thing, but it's certainly changed through the course of my career. I would say markets were much more simplistic when I started. It was like economic data equals strength of economy, strong or weak, therefore equals the value of asset prices. Nowadays, there's this cocktail of the economic data points that we're looking at, but then there's this uncertain policy setting, which is now somewhat polarized in much of the world in the last 10 years after Brexit and the rise of more populist type of policy setting. That means then that policies is more radical, so there's more room for large distinct shifts in these things. And things are very changeable then on a geopolitical level, as we're seeing. So the trade war, things like that, these things aren't going to go away. And particularly, I think things like COVID proved to a lot of countries, like, our dependencies in certain trade relationships that exist is probably too much. And having gone through in my childhood an era of globalization, we're now getting a retraction of that, where it's much more isolated and insular thinking. And you're seeing that with the US administration and the frictions with Europe and China. It's not just China, it's everyone. So I'd say that still is one to watch, and certainly we've got the US midterms later this year, and so you're going to hear a lot more from Mr. Trump in the coming months, I can guarantee you that.
So speaking about Trump, there is a phrase that has floated around in markets recently, which is TACO, so Trump always chickens out. What do you make of that idea, and how do you think investors should interpret political rhetoric versus the actual policy outcomes?
I don't know who was responsible for creating TACO. That's an acronym, but
I think it'll FT.
I think I tip my hat to the FT for that one. I think with Trump, something that I was very much watching markets during his first term, so in 2016. So I saw what he was like and how markets behaved during his first period as president, and then the difference this time. So I guess if you're 20 years old and you've just coming into markets now, you probably don't remember the first era, and you think this is just normal what he's doing now. And actually, he is far more committed to the conviction behind what he's saying this time than last time. Last time, I think there was North Korea was a real big issue at that point in time, and he's kind of strong-arming North Korea into lots of, he got the Nobel Prize and peace in North Korea for a momentary period. So when he first started the second term, we were all kind of like, well, it's completely tacoed. Like, whatever he says, he's always going to back down. This is just the art of the deal, Trump strategy of negotiation. The problem you have, though, is that when he came out with China, before he would have threatened, and then it would have been a very quick process to bring the other party to the table to negotiate. The problem with China is he threatened, and then he upped the ante, and then he went again, and the tariff rate went 5 notches higher.
Yeah.
And even people with experience, we were like, wow. And then the market started to fall, and a big difference we used to joke about the first time, we used to always sort of joke that Trump's got like a Bloomberg terminal by his bed in like Trump Towers in New York, in Manhattan. And he probably is tweeting, depending on where the stock market is, that would be the kind of joke. This time though, the difference was the market was falling quite aggressively during that, you remember the kind of April, March time of last year. Market fell 20% at one point, which is large in just a matter of weeks. And he wasn't backing down. That was very different from the first term. And so at that point you were like, maybe we're wrong here. Maybe he is gonna follow through with this. So the taco trade is all well and good in retrospect. Everyone can always go, should have bought Bitcoin at $2,000. Like, I'll be a millionaire now. I think you need to think about it slightly differently, as in, what is the baseline expectation at that moment in time? So now taco is bedded in. So what's the tail risk? The tail risk is he follows through and actually does something. We're not prepared for that, because we think the default is he's going to chicken out. What if he doesn't? There's always this, kind of tail edge scenario, and that's always the one that creates the biggest market shock and also the biggest market opportunity. So it's kind of being cognizant of the general market consensus, market positioning, and then in what scenarios, like how do I play safe and follow the consensus, but what if scenarios, and how do I hedge against that, or position myself to take advantage of that if it materializes. So, and then the other thing more strategically is, if you think about Trump, the midterms are happening in a few months' time. So think about any political leader going into a sensitive event where his leadership is on the line in the sense of his control on Congress. He's going to be saying all sorts of things, and that the news sphere and the intensity over him is going to increase the closer we get to the voting. And so, think about then tactically, well, what does he need to do to appeal to the electorate? Well, it's kind of the usual themes. It's about being tough on crime. It's about being tough on immigration. It's about oil prices, because that's the average Joe filling up his truck. So that they're sensitive to these things. You can almost predict what he's likely to focus on. Is focusing on the Russian-Ukraine peace deal really going to win him influence at the midterms? Now, thinking completely objectively, that's probably not a priority. And so a peace deal happening there. So if I was trading like Ukraine wheat prices, for example, I'd be considering these things on that side. Whereas on the US side, it's of a lesser significance, because I know he's going to double down in these certain areas. Like for trade, for example, against China, he needs to talk strong against China, because he needs to show that his administration is winning in that sense. So again, you can tactically plot this timeline, and you can it's almost like game theory. What does Trump want? What does he need? What's his desires? And so then what's he likely to say in order to engineer that? And therefore, what are the most realistic things that could happen, and those that are probably more just optical kind of scenarios that he's doing to galvanize an electorate. But that's the part of markets I find really fascinating. The whole kind of modeling out economic data, I find it's not for me. But thinking about these kind of strategies of basically human behavior, I think is really interesting, and Trump makes it actually very interesting for that side.
So about the markets, like looking ahead, where do you see the most interesting opportunities or risks in the market over the next 12 or 18 months?
Yeah, so it's probably the interest rate one. So just to kind of extend on that previous response. So what if interest rates don't come down as much as we expect, or at all, for example, and say the US economy proves to be far more resilient than we thought. If you think about that going into what we just said, if we have a really strong economy, that's going to look great for Trump.
Yeah.
And that's going to mean then maybe he can hold on to some degree of influence in the Congress, and therefore he can continue down that road later of more aggressive type of policy setting on his side. So there's kind of like periods depending on your duration that you're interacting with the market. So where might we be in 6 months could be quite different to where we might be in 12 to 18 months, for example. So again, that's the way I always kind of think about things. There's like the roadmap. Then there's also, you have to, within that, think about, well, what could have the other shock events that could occur globally that could influence these things? And geopolitics is obviously, very topical at the moment because of all the things that are going on. Whether it's, for example, like Trump intervention in Venezuela. I mean, you look at it now and you go, oh yeah, he just wants the oil and this sort of. I mean, would I have thought that would happen? I think no. But he did it, and then interestingly, the market reacted far more violently the week after, when there's the ongoing protests in Iran. And it wasn't that. I mean, I can tell you now with a fairly confident degree of certainty that it's very unlikely that there will be heavy US military interventions in those areas, because it starts to then create a potential contagion effect in the Middle East. And the last thing the US need is to send their troops and have a lot of budget and focus in the Middle East when I need to be talking to the American electorate in 6 months' time. That's just a waste of financial resource and capacity and energy. But interestingly, because of the surprise nature and the forcefulness of their intervention in Venezuela, him just saying, we might do something in Iran, oil prices moved quite a bit. So again, these things are unlikely to happen, but he continues to surprise us. And the more that these types of things happen, the more defensive I think that nations will become. And by definition then, the more uncertain these relationships will be in the future. So that's again another thing that seemingly is becoming worse, not better, in this current state of play. And even the relationship with Europe and the US with the whole Greenland scenario. That's another perfect one where when you actually start to unpick it and look at the legal contracts between like Denmark and Greenland and then the US and Europe, and then you're like, no, this is not going to happen. He's not going to do a Venezuela on Greenland. It's just really not possible in many different ways, economically, legally, and all these different things. But again, this is where, as a student, I encourage people to like question these things, because when you read financial media, you're like, oh my God, he's just going to buy Greenland and he's just going to send the military there to take it if he doesn't, because that's what he's saying. So yeah, these are kind of main risks. So probably policy, both on a monetary and a fiscal perspective.
But what he did in Venezuela, was that legal?
Was it legal? I better get my lawyer present. I think that probably splits opinion, and that will probably wash out in the years to come on whether or not he had the right to do that. It's not my job to really give a view on that. The one thing I would say is that I guess a key takeaway there is that yes, Venezuela has a huge deposit of crude oil, the biggest in the world. There's a whole multitude of problems and reasons why oil prices did not react to that scenario. And fundamentally, it comes down to the fact that anywhere where there's a high degree of political instability in any commodity, when it's a physical, tangible product, means that then the ability for infrastructure to be built is very limited.
Yeah.
So you can have all the resource in the world, but without a stable government and stable relationships from a trade perspective, it's almost impossible then for any private corporation to come in and go, I'm going to commit tens of billions of dollars. Because don't forget as well, people tend to think, like in the movies, a guy turns up, massive truck, big drill, bosh, starts digging in the ground, big twirling kind of thing, and then out comes the oil. It's like, it doesn't quite work like that in reality. It takes a long time to set up the infrastructure. In that period, Trump's already out of the White House. Well, so then where do we stand then? Because if the political winds change, then the likelihood is there'll probably be somewhat of a withdrawal from that of being such a positive action that was taken, and therefore a lesser likelihood of that going ahead. So yeah, it's kind of these sorts of things that I tend to think about.
Yeah. So let's move on to get a deeper dive into how markets really work. So with retail investors, they get a lot of attention online, especially in social media. But in reality, who truly drives the market movements? Is it like hedge funds, central banks, corporates, or like a combination of all of them?
Yeah, they're all players within the system. I would say their level of influence is probably slightly different. Probably the easiest way to think about it is like an organizational pyramid, so like a triangle. And at the top of that sits your central bank. And your central bank, not only does it set interest rates, the other important tool that they have at their disposal is forward guidance. So communicating what it is that their intention is by how they describe inflation, growth, jobs, and therefore by definition what they're communicating that interest rates will be in the future. So that forward guidance is critical. They are fundamentally, what they end up doing with policy will dictate everything else. Now what's critical though is the next layer down in the pyramid, which is then these interbank dealers, these financial institutions that sit there, because they grease the wheels of an economy. They're the liquidity providers. So like we said with the RBS scenario, that they're like the heart of the system. And then you have like my head and my hands and my legs, and these are all the other kind of financial institutions, which then are my veins, which go out, and that is the individual companies, the consumers.
Yeah.
So you kind of think of it like that. But if there's a problem with my heart, well then you start to get a bad flow of blood in my veins, well then that starts to impede, as it did in the financial crisis, the ability and access of us as companies or consumers to credit. And that's really the key point. And the kind of the retail investor, it's kind of a similar sort of thing. It's almost like the after effect, the aftermath of a lot of those other components. The other thing as well, as I don't think to underestimate, is the function of corporates within this. The businesses, because it's businesses that are borrowing money. It's businesses that are paying interest. It's businesses that are hiring people in the labour market. If they're not functioning or able to have visibility and confidence to borrow and grow their businesses and so forth, then ultimately that impacts the economy, which then subsequently impacts interest rates, which then will influence asset prices. So it's all very interconnected. I'd say central banks are the key at the top of all of that. The biggest risk that is associated with the central bank now is credibility.
Yeah.
What if they're saying we're going to do this because this is how we see the world, and all of a sudden something happens and they don't do as we thought? My behavioral science or psychology would be, well, next time you tell me you're going to do something, I now don't believe you as much as I did the first time. So when they try and utilize this tool of forward guidance, now it doesn't have the same reaction in the market. And then, big problem, there's a disconnect between market prices and central bank communication. Central bankers are essentially trying to keep that relationship as narrow or tight as possible. And the reason why asset prices move day to day is there's a divergence and convergence of where the central bank is kind of guiding us as to where we think prices are at the moment, or expectations are. And that's formed by how is the economy doing? GDP comes out, CPI comes out, and we think what they're thinking. And so we're valuing things, and then they communicate, and we're either right or wrong. And that divergence, convergence creates movement up and down in these different asset prices. So Yeah, but retail traders, another big problem that they face, of course, is like access to the market. They don't have as good information flow. They can't execute as in such sophisticated or timely ways. I mean, I'm trying to day trade now as a retail trader look, I take my hat off to anyone who can create a systematic or algorithmic way of scraping Reddit to pick out the next kind of meme stock and buying some out the money options or whatever. Like, I'm all for that. But in reality, that's a niche. That does not move wider financial markets. You know, when everyone was going crazy about GameStop during COVID and all the BBC was talking about GameStop, and it's like, in reality, in financial market, no one cares about it. Like, it's such a small story. It's a great one because the narrative underlying it is that it's like David versus Goliath. It's the retail against the hedge fund. It like that, they don't care about any of that. Like, the hedge fund lose a bit of money. It's like, it's no great shakes to a large degree. There's bigger things that they're doing and working on. And the hedge funds, you know, when they're looking at markets, it's much more, you know, the size and magnitude of what they're looking at is just different level. So look, I don't wish any ill feeling towards retail traders, but my advice is always, I think, be sensible with it. As a student, you should be looking at investing as a means to improve your understanding of how markets work for your future applications, interviews, and so forth. And with investing, you know, what I've come to find is like my withdrawal from the intraday market was quite a long process because I was quite addicted to it. Whereas now I just look at it with a way more longer term view, and I think about investments over a long term, so multi-year, for example. And that's such a liberating place to be, because when you work in such short term, everything is important and everything influences everything. But if you step out of the noise and look at things over the long term, well, what are my investment objectives? What amount of time do I want to commit? And that's not just physically, but emotionally, because when the shorter time frames, there's a lot of emotional burden carried with that as well. Whereas if you change it, it's just much more easy. You don't need to get so bogged down in like the daily noise, so to speak, which having a family and kids and things like that changes over time.
That is great advice. So now, turning to AmplifyME, can you talk about how the company is using technology to improve finance education and recruitment for young professionals?
Yeah, so this I've kind of distilled it down to three main sort of pillars. So the first pillar is core to what we do, which is learning by doing, so experiential learning. I think this has become, I was on a call yesterday with a big consultancy firm, and they were doing a webinar with all these early careers teams in big financial institutions, and they're all finding the same problem, which is AI has just totally disrupted the early top of funnel careers hiring for large financial institutions, namely because all the students look identical. You know, you all look like Gemini or ChatGPT or Claude or whichever one you're using, and so you all look the same. And so therefore, what's happening is not only that, you'll do the numerical test and all the students will cheat in the numerical test. They'll do the situational cheat that one as well using AI. And then you'll do your interview virtual, you'll cheat that because you'll have the audio playing with the auto response. So it's become a real challenge for financial firms to identify genuine talent. So where we'd come in is, you know, on the student side, there's this learning by doing, learning to make a better judgment over your actual skill set in an applied way. So a better fit, an alignment with the job. Because how do you know you want to be an investment banker? I mean, the reality is you do an internship and you're kind of like moving images on a PowerPoint and doing these sorts of things. Like, that's not really giving you much feedback on, right, what about actual, you know, building the model or dealing with the client and, you know, negotiation over a deal, for example. But we can put you in these situations so you can be more informed. But then from the employer, it's this assessment piece, which is, right, okay, you look good, so let's actually see whether you're genuine. And in that environment, then what we can do is look at all of your behavior, your interactions on our platform, and we can identify signals within that as to then what would that align to what a successful profile would look like within that firm, within that role. So more and more we're working with organizations where we have this ID program where we'd interact with at the very beginning, like literal spring week to summer to grad to the first few years they're in the firm. And then we're looking to map then their progressions, and we're looking to then look at successful people within the organization and map their underlying characteristics. And then when we're dealing with all of the students around the world, we can then match within our data pools signals we're getting from a very elementary level of interaction to that person's showing an exact profile fit that potentially they could go down the same path and be an alpha performer on your desk, for example. So that's really what we're doing, is kind of experiential learning, which I think is super critical now in the current era that we're in. Then it's assessment, and then the other part is kind of being able to do that at scale. So being able to have a platform that centralizes all of those activities, where the user can come in, the hiring manager can come in. We've just created one now where, say like a normal traditional interviewer would say, tell me about your CV, tell me about the time you did this project. What we're able to do is post-simulation, the assessor gets this report, and within the report they can see how this person reacted during every major market bit of information, the decisions that they made, the amount of money they allocated to the trade, and then they can question them based on a tangible experience they've just had. Now, if you think about that as an interaction, it's such a more high value interaction.
Yeah.
The student gets to actually talk about something real, not rehearsed. It's not like this perfectly polished response I've been practicing for days. It's no, you get a real expression of a feeling. And that's what you're looking for as a hiring manager. You want to see, like, I don't want the perfect answer. I want to see what you're like. And so then they can really probe them about very specific things. And what we see is the hiring managers find that super useful, because it's gone from something that was quite standardized and very unpersonalized to something very bespoke for each individual, which is better for the student, better for the hiring manager. So yeah, it's kind of in a nutshell what we're doing and what we're working on at the moment.
Yeah, I completely agree with that, especially like from a student perspective. When you engage in an interview where there is so much like development, even in the interview stage, like you learn new things or like you experience something new, it's much more beneficial for me, like when I'm doing an interview, than just like with the standard questions, like as you said, you practice, because you can know how exactly you can improve and develop in that way more. So yeah, I definitely think it's very valuable. So moving to the second question, what are your views on the edtech industry? Because there seems to be a huge potential, especially with advancements in generative AI, etc. But there are a few large success stories so far. So what do you think of this?
Yeah, I mean, like I said, I was on a call yesterday, so it's quite fresh in mind. I think with generative AI, a lot of what people were talking about were sort of these personalized journeys. So this is like a big thing about AI transformation in big organizations, where, rather than in traditional learning, it would have been we all attend a course or complete a course or a program, we go to a lecture hall. Whereas now, like, your needs when you're studying to your peer on your same degree might be slightly different. And the AI is intelligent enough to understand your previous mark, how long you took, all of these different markers to then serve you a completely personalized experience. So I think that has a lot of potential and a lot of benefit. I know for one, I remember when I was studying my A-levels, I did statistics, for example. And I always felt very intimidated because everyone seemed to know everything. And I used to sit there going, I don't actually know everything, but I was always a bit scared to put my hand up because I didn't want to look, everything I try to tell students not to do is I was exactly the same, right? I felt embarrassed, I didn't want to come across as, stupid, these sorts of things. So I wouldn't ask. Whereas now, this is where the AI tools, for example, could intervene and at least, give you some sort of supporting material. Okay, what is it you don't understand? Okay, have you looked at this? Have you done that? So I think these are all, really good things, and that then it provides a feedback loop, which again is this personalization from not just serving the right type of material, but then how are you progressing? How are you getting on? And then having it to learn from your patterns of learning. Like, you might be really good at coming early, you might be really good at operating late at night, for example. So therefore, what's optimal for you? Do you like to consume the recorded lectures? Do you take notes? And everything starts to become aligned with what's going to create the best outcome for you. And then there's content creation. So, now for, your job that you're doing now with this podcast, for example, I'm sure you use AI tools to help make your process more efficient. And that goes with everything. A big talking point though with these corporates is there's a big difference between students are very early adopters of new technology. Employers, for lots of reasons, cannot adopt them so quickly. So one thing to be aware of or cognizant of as a student is, you might be vibe coding, you might be doing all this other stuff, but then actually when you get into the business, everything's removed. And the reason why is because there's security risks, so cybersecurity. There's lots of other, they've got to have their own internalized model that they're developing and working on. A lot of it's sensitive, particularly financial services has a high level of compliance and regulation, more than most industries. And all of a sudden you're like, the last few years I've been hammering these AI tools. I'm using Claude for this, I'm using ChatGPT for that, I've got Gemini doing this, you've got my agents working with each other. And look, you will need to choose your own environment you want to work in. If you work in a startup like at Amplify, if you came to me and said, I've made this system using all of these different tools communicating with one another, I'd be all for that, because we're small and we can be agile in that way. But if you walk into, say, a big US investment bank or a legacy, a lot of it is legacy architecture. It's not like, right, let's just pivot and use this. They have quite often old infrastructure that's being built upon in layers. But the problem, as you'll know, is when you build on layers, then fundamentally, if you change something at the top, you've got to go all the way back down the stack to find what the issues are. Whereas as a small firm, it's completely vanilla. You just go bang and you can run. So don't become too dependent, though, is what my advice would be. Understand how to use them, but you could be restricted at times depending on your environment. The other thing about education is it's always hard because of the time to impact. What I mean by that is, say if we were trading, if we were day trading today, I could know by the end of today whether you're good or bad, from a simple P&L perspective, did your investment work or not? Whereas in education, how do I know that you guys are Imperial? So my statistical evidence would suggest that the alumni of Imperial will probably have a statistically higher probability of working in financial services, hitting a certain income bracket, going to certain type of roles, right? But it's going to take me 3 years for that to play out, or a year on your master's program. I don't get that immediacy feedback. So one of the things that's a challenge, I guess, in EdTech is that it's how we get the feedback to measure the success of what we're implementing is one of the things. It's going to take time. It's okay, so you're using all these tools, productivity's gone up, but actually, do you end up getting better jobs? Do you end up getting better grades? What does that actually look like? We won't actually find out until those periods pass. And then the other thing, of course, is that I was talking about financial institutions, but academic institutions are even slower to move than corporate institutions. And so the adoption of that. Now, I remember 2 years ago when ChatGPT kind of broke out, the first thing all of our university clients were telling us was ChatGPT banned. Students aren't allowed to use it. Full stop, not allowed to use it. Within months, it was, okay, they can use it. Because the problem is that, you can understand the defensive nature of a process of doing things that's been in place for, in some cases, hundreds of years of learning. This has come along as a real disruptive moment in education, and there's going to be some defensiveness around it because there's a lot of uncertainties. How do you use it? What does it mean? What does it mean for me in my job and things like that? As we've gone further down the track 2 years now, we're talking to employers where they're like, no, you can use AI within the assessments. We want to assess then how you are using the AI. It's not the AI, you can just use it, with complete freedom. We're actually mapping in one of our quant sims how much you lean on it. We can look at the screen and look at your coding and how you're interacting and prompting the AI as to understand then what sort of balance is it between you and the machine in terms of the inputs and the outcomes. So this is where it's heading. And you told me that Imperial, the new course that they're doing, instead of having straight economics, which will always be an option, you can do economics with computer science, with data analytics. And I think that is 100% the way that these institutions should be heading.
Yeah.
Because from what I get from the employer side is these are all of the skills that will future-proof you for your long-term career. But again, it depends on what type of job. I mean, there are always going to be traditional economist job working perhaps in the public sector or something like that, where sure, it's not such an emphasis on technology, but most trading is heading in a quantitative way. And that doesn't mean you need to be a quant trader, but you need to be able to understand data and information and be able to probe information, analyze things like that, which are these core skills.
Yeah, I feel like especially with when you're learning like the fundamentals, I think it's very important to take the time to understand it yourself, and then once you've mastered those foundations, then you could productively use Gen AI in that sense. And that's how it's been, for example, taught in the course. Like the fundamentals, we don't use AI that much because we need to know ourselves, so we can then use the AI efficiently to build upon our knowledge, which I think is
it's a really good point you made there, and it's one that I'm seeing now only at the end of this multi-year period that a lot of students are coming from, which is getting used to discomfort, because that's something that will happen throughout your career, throughout your personal life. This is just life in general. What I fear is that by over leaning into these tools as a young person at a very formative part of your development in terms of your technical knowledge, for example, and experience, is that you don't build up that tolerance, that underlying curiosity is evaporated, that self-starting motivation to want to improve. The reason why is because you ask a question, you get a response. There's no longer this seeking and quest, and when you used to go on a quest for information, it's like, oh, it's not quite right, where do I go, who do I talk to? That's how you solve genuine business problems. That could be a trade, but it could be in any business context that you're doing. You're solving problems in various different ways, and often a lot of problems are human orientated. The problem is the human, and so that's outside of the box of doing a lot of what otherwise is quite administrative type efficiency, productivity gain type stuff. So those skills to build resilience and acclimatize to discomfort, that's the only way that we as individuals can improve ourselves. And if we remove that out of the equation, then what might end up happening in these early years to come is you end up getting the role that you desire, and all of a sudden you're just not able to cope with it because something is removed, or that you just haven't built those muscles, not physically but mentally, if you like, emotionally.
Yeah, I completely agree with that.
And how do you think the AI is going to affect the generations that are going to come?
Yeah. I mean, I wrestle with that because I have 2 young children, and obviously when I was young, me and my brother were the first in our family to go to university, and it was always go to university, because you go to university, get a good job. And that was fine, because when my brother went to university, we got paid to go to university. We're so old, the government used to give you grants. They would pay you to go to university. You didn't pay fees, because at the time, the current government of the day in the 90s, it was like, we want to upskill the nation. So it was like, we want more people to go to university. That probably went a bit too far, and then everyone goes, and it kind of degrades the value and the quality of it. So when I think about now, well, if I've got a 3-year-old and a 7-year-old, and we're thinking about education, like, what's university going to look like in 15 years' time? And this I find a really interesting like concept to wrestle with, because I don't actually know, and the rate of change is so rapid at the moment that when I talked about that idea of personalization and feedback, it does bring into question then the validity of the traditional way of learning, for sure. The commitment of going to, say, a university as the one source of knowledge is probably going to change. So knowledge will be democratized, which, because I'm very passionate about social mobility, because of my own background, is something that I would really encourage and enjoy, and I think would be quite liberating for more people to have access to information so that they can learn. Obviously, we're at a point at the moment where, who are the people who can afford to pay for Gemini and ChatGPT? Well, it's not. You can say, like, we want to democratize education and finance. Well, is a normal state school education system going to then provide these AI tools? No. Will the private schools provide it? Yes. So actually what you might have is this weird further division between those who have access to tools and those who don't, rather than this utopian view of it's going to lift all boats because it's out there. But, you know, if you're an uneducated person working in a non-professional job, what incentive do I have to go onto an AI tool? It's just not part of my workflow and things like that. So yeah, I don't have an answer at the moment, but I do think the educational system is probably ripe for modernizing. We're part of that. We act as a consultant almost to a lot of universities. The reason why we work with Imperial and all these other universities is because of this very reason of making learning experiential as well, so that students can learn a lot of these real tangible skills that make them better prepared for the workforce rather than just technically proficient. So I think we're definitely moving like that. I think we're quite well placed given what's happening with the societal shift and AI adoption for what we do as a business. And hopefully that has a good outcome for the students, which ultimately are the core to this equation that we're doing.
But like, for example, right now we're using AI to write all our emails, all our letters, all our essays, for everything. Yeah. So, but for me personally, because I have had a lot of practice during my schooling years of writing essays on my own, I think I have inbuilt a little bit of creativity on my own in that way. Yeah. But what about the really small kids, like who are 2 years or 3 years, and when they'll be using AI to write essays and all that, they'll not be. How will they develop that creativity?
Yeah. I mean, look, it's an interesting question. I know where you're heading with that. But I kind of think about it how I use AI tools nowadays. So big part of my job is content creation. Now, do I use AI tools to do that? 100%, like definitely. Now, how I would use it though, and the way I like to think about it is, it's not that those skills are going to be made redundant. I just think that there's different skills and different roles that will emerge over time that probably haven't materialized just yet. So for example, I find it quite liberating because I can have an idea now, and in my old job, it would have been, I'd need to talk to my team, we would have a brainstorming session, we'd shoot some ideas, someone would run with it, come back with some feedback, some information, we'd piece it together, and it's kind of the normal workflow. Now that just happens immediately. What I find then is it liberalizes me to be able to come up with some really genuinely unique, thought-provoking ideas, and the path to execution is far easier. So now I can do things that I wouldn't have been able to do before, like when it comes to content creation. So I think for a lot of the younger, super young generation, I do think that there's probably situations like with every evolution of technology we've had in modern history, where there's derivative kind of jobs that will come out of that we don't even know about yet. That will be the case for sure.
Probably there'll be no jobs.
I definitely don't think that but you know, if we were to go back to like the advent of the railway, if we go back to like electricity or whatever it is over time, the internet, you know, the similar argument emerges each time, and there is always a subset of jobs that are lost, and this will be no different. The difference here then is about, well, what jobs then are gained on the back of this, you know, and like, you know, the internet is one, making the world interconnected in such a way has created such an economic productivity boom, because now everyone's able to deal with everyone in simple forms. And so I could live in a small rural town in Indiana in America, but I can have access to be able to ship my t-shirts that I make to anywhere in the world through logistics, through e-commerce and all these other things. So, you know, those jobs, they didn't exist. And I feel like this will be the same. It's just that it's very hard to pin down what exactly those would be. I'd say what you probably could do though is think, okay, a lot of this is led via the technologies. It would be prudent of me to study what you're studying, you know, be proficient in coding, be aware of new technologies, you know, follow these frontier labs. What are they working on? You know, how are they solving these issues? What is the real world implications? What are the regulatory barriers? Like, have a natural curiosity of following this stuff, and you'll probably be on a faster pulse to then catch the change as it's emerging. So yeah, not sure that answers your question, but
I guess moving on to, for students who are interested in like finance and investing, let's say like a complete beginner to the field, what are your best tips for building, you know, their genuine commercial awareness, and what resources could they use, for example?
So a big mistake I think that students often make is they try to run before they can walk. So someone will say to them, right, you want to get a job in finance, you need to know everything. And they'll be like, right, I'm going to do this, I'm going to do that, I'm going to take part in everything. Like, think of your brain is like a muscle. And the analogy I always use is like going to the gym. So you start off, you have the physique or health that you have, and you have this ambition. I want my heart to perform better, I want to have more muscles, or whatever it might be as your goal. Now, there's a journey to get to that end outcome. Now, what can often happen, and often does in the gym as well as learning about finance, is you go to the gym day one and you pick up the heaviest weight and you go, and you do like one rep, and then your body the next day is just broken and you're like, I'm not doing that again. Because you've approached that problem with the wrong solution. You've done too much too soon. So one of my first bits of advice is try and form small daily habits, of which then compound over time. Now, what are those daily habits? So those daily habits could be, for example, I know at Imperial you have access to like the FT and the journal, stuff like that. Now, I would not recommend reading the FT cover to cover or like going through the entire articles on the app. The reason why is because not all of them are important. A lot of them are interesting, but not really important to learn and educate yourself about what's moving markets, for example. So a good practice, I'd say, on a daily habit would be, you've got the app on your phone, and generally a lot of these financial media websites or apps will push the most prevalent news to the top, and then they'll have sub-articles which are feeders into that top narrative story. So you have breaking story, top level, with then talking head commentary and analysis as sub-reads. So day to day, I just focus on those. A better way to do it though would be to go onto the FT and just type in on Google FT newsletters, and the FT have, I don't know, 25 different newsletters. And if you're a subscriber or have subscription access to the FT, you can subscribe to any of them. I wouldn't subscribe to all of them. I'd align to your area of interest that you have. So they have one that's to do with M&A and deal making and advisory. They have one to do with asset management. They have one to do with commodities. So follow your niche. And instead of then having to trawl through an app or a paper, you have an aggregated, curated feed that's industry specific to your area of interest. And so in the morning, for example, for me, when I commute to London, I'm on the train for 45 minutes. I'll go through maybe 3 different newsletters. Each one I'll read for no more than 3 minutes. Because I don't read the whole newsletter. It's an aggregated tool of these are the 5 stories I should read. And I have a flick, oh, that one's interesting, I'll read that one. And then I move on to the next one. So you can build out this repertoire of way of consuming information in its most efficient way. Like, I don't recommend anyone sit there for an hour every day just kind of, looking at their Bloomberg screen and it's fine if you really want to do that. I wouldn't stop anyone doing that, but I know for one what students are like. You've got to study, there's pressures of getting your grades, you've got project work, you've got a part-time job, you've got socializing, you've got sport clubs, you're running the podcast. I think you need to do all of those because they develop also very good complementary skills. Socializing is a good thing, right? You've got to relax your brain. You've also got to develop other social skills to be able to perform in a workplace. I wouldn't neglect that stuff. So daily habits are key. Little injections of information, but so to supplement an app, a newsletter, a podcast is useful. A podcast can come in short or long form. The one that always comes to mind is the Morgan Stanley thoughts on the market.
Yeah.
That's really useful for a few different reasons. One is that it's 3 minutes long. So every day, what I do is I follow that and I put the bell icon on so I get an alert when it's released. So every morning you wake up, I'm going to listen to that. 3 minutes. So literally I could walk from here to South Kensington Tube and I've just literally had I've sat in on an intimate conversation with the head of European equities talking to the head of rates about something. That is gold. When I started, there was no way I would have had access to those people. Podcasts were not a thing 20 years ago, right? Whereas now I can just listen in and 3 minutes, I can get a summary of the moment of the day. And then it's a compounding thing, like the gym. What you've got to do is consume that podcast every day. So 3 minutes of every day. When you first do it, you'll be I lose concentration after 90 seconds. It's all very foreign to me. I don't fully understand it. Those first few weeks will probably require you to write down the odd word or two and go on to Gemini and go, explain this to me, which is totally cool. That's fine. And then after month 3, all of a sudden, you're almost starting to be a participant. Yeah, you know the context. You're able to predict. You're able to provide evidence. You're able to understand what they're talking about. That makes such a huge difference then when you interview with someone, because then I ask you about what do you think about rates for 2026 and the US midterms, and you go, well, actually that's a really interesting question because of these 3 things, and then you go bang bang bang, and I can see in your face that the way that you're articulating it, this isn't memorization of the journal or FT. This is you are a market participant. You are already someone I can envisage on my desk. You are already talking my language now. So not only are you clever, you go to Imperial, I can see there's a distinct interest that you want to be here. And that's almost more important because there's a lot of clever people out there. I got to know that you want to be here and you're really enthused and interested and motivated to want to know this stuff. So they're the kind of main things that I would do. Longer form podcasts, what's quite a useful hack is to just get transcripts and then put them into your AI tools to summarize. I would do the same with any research notes that I see. So if you go onto the insights section of any listed sell-side institution, they'll have lots of macro research, these sorts of things, but they can be 20, 30 pages long. Put it into your tools and then just probe questions like what's the central theme around the US dollar, and it'll just give you an answer. You don't have to sit there reading right, I'm going to print out this 50-page research document. It's not meant for you. That's meant for the hedge fund portfolio manager to read, right? All you need is an extract of, right, what's the fundamental argument why they are bullish US equities or bearish emerging markets, whatever it might be. And then so you kind of put all these together and that amounts to real fluency, I would say, but you gotta stay committed.
Yeah.
The moment you don't go to the gym, guess what? Those muscles, they disappear fast.
Yeah.
But think as well, when you go to the gym, it's not just about working out to get muscles. What's the other key component? Health, right? You need to give yourself good nutrition. You need to sleep. The same thing when you're doing that, right? You can't just be knackered, hungover, and then do the habit. The habit is not going to be as powerful or stick as well. So, you've got to get good sleep, good rest, and that doesn't mean, you can have cheat days, things like that. It's the same principle.
Yeah.
But then stick to it and put your mind in the right place where you're physically able to consume the information and digest it. Don't just do it because it's a box ticking exercise and you're like, I know I have to, I've done it. It's like, that's not gonna work well in the long term.
And I also feel like with building like new habits or routines, like the first month, as you said, it can be quite difficult, but then when you get adjusted, like you push through the first month, it becomes so natural and you start to enjoy it much more.
Yeah.
So it would be like perseverance with the small habits that you do.
And the best thing is find a buddy.
Yeah.
Find someone, like the key kind of tipping point of it becoming actually knowledge is when you can converse with someone. So that then requires you to converse with someone, to find someone. And you're Imperial, there's like a big business school. There are lots of people you can converse with. There's societies, there's peers. You must talk to other people.
Mm-hmm.
And your quality of conversation will be fairly elementary at the start. But as you get better and then challenge each other, have differences in opinions, express why you think this, tell me why Elon's a genius and I'll tell you why he's an idiot. Like, these are healthy ways of building then your ability to not just articulate, but to formulate good structural arguments. Yeah. I always think that when, particularly because I worked as an analyst, like a strategist, if you like. So it was always about, in the end of the day, what I'm trying to do is convince someone of a view. And so I always think about it, it's like a jury. I have a jury of people, I'm in a court, and I need to convince them. And how do you convince a jury? I've got to have the strongest evidence possible. Now that evidence can come in different forms, but it's how I construct that argument is really whether they're going to believe what I'm saying or not. And so by talking and having dialogue, you get better at that and you build those skills. A lot of students though just finish academia and it's like they've never actually done that part of the process. They're very good at analysing the argument, but not really so much the presenting of the argument, particularly in a financial context where everything is quick and everything needs to be distilled down. Like, there's times and place for deep research, but a lot of the time it's much more, can you take something highly complicated and make it super digestible and easy to understand? Even the quants struggle with this because the quants have to deal with the PMs and the quants are like down dirty in like the data and building these models and systems. But then they have to articulate what they're finding, the challenges, the problems they're trying to solve need to come from the PM. Yeah. And if they can't really express that and they go too deep in the maths, a lot of the PMs are not from the same background and there's a disconnect. So again, there's these other skills that you need to develop.
Correct. Totally. And for Imperial students specifically, how would you recommend engaging with AmplifyME programs? Do you have like any tips on how to get the most out of these simulations?
So we do work with Imperial in different capacities. So I think it's only if you're master's students, I'm afraid, at this point in time. There's actually stuff that we do with the faculty direct. So the best thing to do is just speak to your faculty if you're on any of the master's programs. For undergrads and anyone else, we run 3 public sessions on a weekly basis. One in markets, which covers things like sales, trading, market making, asset management. And we do one on M&A. So it's more like financial modeling. So for M&A and stuff like that. I'd encourage anyone to make use of those. They're there for public consumption of trying to see what these roles are like, to try and enhance their CV, get some practical experience that they can talk about in an interview. All of that good stuff. What I would say is that from a mindset perspective, come into it with a very open mind, and if you don't do well, that's absolutely fine. Do it again. Like, this is one of the things that I find students, because they're so used to the current traditional academic system, you do a test and you fail, it's like end of the world. In real life, you do something, you fail, what do? You do it again. You learn, you adjust, you optimize, you do it again. Like, this is like the entrepreneurial, like, founder's sort of spirit, if you like. You know, you have to break stuff to learn how to fix it. I think it's the same process, and I would encourage people to use our simulations in the same way. Like, just do it again. And we actually look at people who show a growth mindset by their performance improvement over time. And then we have lots of other stuff that we do that I'm in charge of, which is the podcast, the daily newsletter. All of that is meant to just save you time. You know, we talked about ways to, you know, daily habits. You could, I could be shameless and just say, read the AmplifyME newsletter, because that's the aggregation of the aggregation, if you like. This is like me hand-picking the stories that you as students need to know if you want to get a job in financial services. And then the podcast we made purely because, you know, we're not handcuffed like a big corporate. So we purposefully aim for our show to be much more conversational. It's much more light-hearted, a bit more humorous, but we're talking about all the same things, except we talk about it in a way where we deconstruct it and it's more educational rather than for an investment manager. So it's meant to be accessible. Like, the episode that came out this morning was an interview with a credit repo trader. And most people listening will probably go, credit repo? Like, I've never heard of that, never know what it actually is. And my job is to get people like that to explain what they do and bring visibility to the different roles within finance, because there are lots. And so when students are feeling quite challenged by, it's really hard to get a job, what I always say to them is, are you actually aware of all of the jobs you could do? And then they go, oh, actually, yeah, there's loads of jobs that I never even thought existed. So we use our show to try and, you know, bring to light some of those, as well as the traditional sort of roles.
Yeah. So is there anything exciting that's coming up to AmplifyME that students should be on the lookout for?
Yeah. We've always had these public sessions for markets and for banking. The community has always been saying, you know, when's the quant pathway coming? Now, we work with, you know, some of our main clients are big US hedge funds, so we already do a lot of quant work. We've just never really done it in a public wide sense. We've always done it in quite a targeted way. However, we will be releasing a public pathway onboarding to do like a foundational quant experience. So we've got a new website dropping literally this weekend. So you'll be able to take part in that. The beauty of that is that it's quite an elementary coding exercise, but then if you're quite good at it, what it will allow you is to unlock then access to a whole variety of more simulations, which then also means we can get some more indicators on how you're performing, which could then lead to us aligning you with some of these corporate people looking to hire specific talent. So that's all coming. And then from a business perspective, one of the main products that's proving very popular at the moment is like something called ID, so Trader ID, which is because of the AI problems that I talked about earlier. What big bulge bracket banks really want to do is monitor someone from very early all the way through their journey, so that when they're making a bet on a person, i.e. who am I going to hire, you've got as much evidence as possible to pick what potentially could be the highest performing people, because you've got less of a one-time, highly biased, fairly vanilla interaction and interview or an assessment day. You've now got an entire sequence of interactions that have happened over probably a number of years for them making better hiring decisions. So that's the other thing we're working more and more with other banks with, which is exciting for 26.
Is it part of like the application process that they monitor this individual, or is it part of like participating in the simulations, for example?
It's kind of both. So we're starting to now. We used to be in one part of the process, but more and more we're becoming an end-to-end solution. In a sense of then, you go through this journey of how complicated essentially the experiences become and how then closer aligned they are to the eventual roles that they're doing. The more data that we capture, the more then we can build our model that then becomes more efficient at identifying the trends that signal for that particular desk or role what success should look like. So there's a bit of buy-in both ways. So obviously the companies need to be honest with that journey for us to populate and have the most accurate information that we can. But that's what's super exciting, because I've always had this underlying desire that people should get a job because they're the best at what they do. You could be a man, a woman, black, white, good score, bad score. If you're the best, you should be in that seat, full stop. And that's the ultimate quest. I know that there's certain roles that are more client-facing, that's more challenging because of, you kind of need to work with your clients, and clients like to mirror themselves. So, but in quant finance and in other trading activities, certainly, it is often quite a meritocracy, of which it should be. And hopefully our technology allows that to become more of a reality in the future.
Amazing. Thank you so much, Anthony, for joining us and giving us insights into careers as well as the markets. And before we wrap up, feel free to tell our listeners where they can follow your work, including the podcast.
So the podcast is called Market Maker. So if you go onto Spotify, Apple, YouTube, just search Market Maker, it will come up. It will be my face, unfortunately, that you'll have to look at as the podcast cover. We release an episode, usually one at the beginning of the week, which is more M&A focused. So we'll talk about, I'm recording an episode tomorrow for Monday where we're talking about Elon Musk's acquiring of SpaceX and XAI.
Yeah.
So there's a lot behind the rationale of why he's doing that, for example. So we'll explain this in its parts, right? The regulatory hurdles, the mechanics of the deal, the funding, the investment banks who are involved, what role do they play? And then at the end of the week, we do another episode where it's more of a macro review. So it's more like half an hour on the US CPI print, the US interest rate decision, Kevin Walsh, and we'll do a little kind of summary. That comes out 2 episodes a week, and then we have guests periodically. I've actually got my biggest guest yet I'm recording with tomorrow, so no spoilers, but maybe a hint. He's a very famous person from the 90s who lost $1.2 billion.
Ray Dalio.
Not Ray Dalio, but he's a trader who basically was trading and hiding his positions that resulted in the bank he worked for collapsing, and he lost over $1 billion. So I'm going to interview him tomorrow, and we'll have that episode soon. So it should be super interesting.
Yeah.
And then the other thing is, I'm always happy for people to connect with me on LinkedIn. I try my best to reply to people when I can. It's not always immediate, but I do share a lot of my content on my LinkedIn. And so, if it's either demystifying financial news or career tips, I put a lot out via my LinkedIn as well. So feel free to connect.
Amazing. Thank you so much.
All right. Thanks again for your time, Anthony. It's been a pleasure having you on the show.
Cool. Thank you very much.